Ladies and gentlemen, good day and welcome to Q4 FY24 earnings call for Cartrade Tech Limited. This conference call may contain forward-looking statements about the company which are based on beliefs, opinions and expectations of the company as on the date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vinay Sanghvi, Chairman and Managing Director. Thank you, and over to you, sir.
Thank you, and good afternoon, everybody. Just want to thank you all for joining this Q4 earnings call. Just wanted to start off and say it's been a very exciting quarter for the company, and we had also uploaded a presentation which I'll go through a few slides to give you all an idea of what the company's performed through this quarter. I think on first page 5, I want to highlight that revenues grown by 52%, profit after tax grown by 43% in Q4. We are still the number one automotive portal in India, the largest used car classified business, the largest vehicle auction platform. Almost 17 million unique customers use our platforms, OLX, Carwale, Bikewale, etc. Per month, at an average of per month in the last quarter. OLX, as you know, also has 100 million downloads on the phone, on a phone. There are 350 plus physical locations now for us. 90% of our 70 million customers a month come organically, which means we don't pay for this traffic. Our auction platform, Shriram Automall and the remarketing group had 1.2 million vehicles auctioned last year. Our revenues for the quarter Q4 are the highest ever at almost 161 crores. Our adjusted EBITDA was also the highest ever in a quarter, which was at 49.1 crores for the quarter. And a profit after tax was 25 crores in Q4 FY24. As you know, we are a debt-free company and a strong cash balance of almost 750 crores. When you go to the consolidated results, which is page 6 of the presentation, as you can see here, the revenues grew by 52%. The operating revenue grew by 52% for the quarter. The year-ended revenues have grown by 37%. As you know, here, OLX was only there 8 months in the year, consolidated from August 11th. If you see the adjusted EBITDA was highest at 49.1 crores for Q4. The EBITDA without other income, without our interest income, was up 77% for the quarter. And the adjusted EBITDA without other income, without all our interest income for the whole year, went up 63% or almost 100 crores. If you see the profits of the company, the PBT was 29.72 crores in the quarter, on our highest ever again, up by 30%. The PBT for the year was 98 crores versus 60 crores, which is up 62%. And our profit after tax for continuing operations was up 103%, which doubled from 40 crores to 82 crores during the year. The profit, including discontinued operations, was 25 crores for the quarter. So it's been a very healthy financial and strong financial performance for the quarter 4. If you go to slide 7, which is our standalone results, if you see, I think this is one of the things which most of you have asked is on our margins for our standalone business. In the quarter, margins have grown from last year 19% to this year 26% for the quarter, which has shown a sharp increase in our margin, which is adjusted EBITDA margin without other income. This has sharply grown up. Our revenues have grown up by 20% on a standalone basis for the year. Our adjusted EBITDA is up 41% during the year, excluding other income, which shows that our adjusted EBITDA is going up at double the rate of our revenues. And profit after tax on a standalone basis up 29%. It is slightly lower at 29%, up because of the reduction in our interest income because of the acquisition of OLX. So really, it's been a strong performance from the standalone business as well, and margins have grown out there. If you look at slide 8, which is our remarketing results, even though it's been a flat year in terms of revenues for it, its profits have slightly improved 8% in this quarter. Adjusted EBITDA is up 8%. In fact, adjusted EBITDA at 16.3 crores is also reasonably good with 29% margins. But on the whole, revenues have been flat in this business and profits have been also flattish during this current year. And this is as a fact of repossession vehicle supply coming down, which has been mostly replaced by a retail supply of vehicles. If you look at slide 9, which is the OLX India results or Sobek Auto results, as you've seen here, we had last quarter a discontinuing continuing operations. Now this quarter, March 31, we only have a continuing operations, and as we had indicated at that time, the revenue is now close to 45 crores, and the profit or the adjusted EBITDA is close to 11 crores, which is very similar to last quarter. Some marginal costs have gone up from the last quarter, which have come to the continuing business, but overall, it's almost at a 9 crore profit for the quarter. And we're quite confident of sustaining and growing this from here. It's a tremendous base. As I said, a lot of the work last year for OLX India has been, the technology transfer, putting together the product and the technology team, getting the management team in place, shutting down the loss-making businesses, and all that has been completed. And as you can see in quarter 4, a completely only classified result of 45 crores and 11 crores profit out here. This is what I had to say. In fact, the brand also on Google Trends, if you see slide number 11, shows strength of the brands of Carwale and Bikewale. On slide 12, you can see the brand of OLX continue to be strong. And as I said, our traffic continues to grow. So this is what I had. I'm happy to open up for questions and answers now to answer all your and clarify all your questions and doubts. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Mr. Vijit Jain from Citi. Please go ahead.
Yeah, hi, thanks. Can you hear me?
Yes.
Hi, Annie. Vinay, congratulations on pretty terrific results here that we can see across the 3 businesses. My first question is for the OLX India Classifieds business, are we looking at what will now be the recurring cost structure for this business now? And also if you can, talk a little bit about growth in this segment, because since you acquired this company, it seems to be somewhere around 43 crores a quarter revenue business, pretty steady at that. So your thoughts on that? That's my first question. Thank you.
Thanks. The OLX costs are fully now, this is what the costs are. I think the continuing operation is probably steady state. The reflection of financials of Q4 are the reflections of steady state for this business. Obviously, our attempt is to grow this 44 crore quarter revenue from here. And it is a typical, classified kind of marketplace where as revenues grow, costs don't grow in relation to the revenues. And you'll see that now in the next few quarters that as our revenue continues to grow here, that profitability will rise at double the pace, which is, as you see even in the consumer group. I mean, as revenues grow, our profits tend to grow at 1.5 or 2 times the speed of revenues growing. And we want to have the same dynamics here, where increase in revenue multiplies growth in profits. I think this is a leverage we have on our costs. Again, here there's very low marketing costs, almost zero marketing costs, and reasonably, high leverage to profitability with revenue growth.
Got it. And any thoughts on sharing more, metrics around OLX India, traffic trends, category-wise mix, those kinds of things, now that, this business is, on a recurring basis?
Yeah, sure. We will, and I think the traffic tends to be about 30-odd million UVs a month. As I said, a large part of it is on an app, on a phone. Almost all of it is, zero net of marketing. There's no marketing cost to this revenue, to this traffic, which is making it, giving it, the OLX business strong margins. We'll start sharing the traffic metrics with you, very soon. Now that there's some stability, that's something we'll start doing. If you look at the segmentation also, automotive tends to be about 45-50%, the rest is non-automotive. That's the other segmentation of the classified revenues, which also, over time we'll start sharing in a breakup of automotive and non-automotive.
Got it. Thanks, Vinay. Then my next question is on the remarketing business. Fair to say that overall this business seems to have bottomed out from here. I see the volumes are still down on a YOY basis, but The decline seems to have reduced and revenues are flattish YY now, declining for 3-4 quarters. So that's my first question on the remarketing business. And is this coming from, continuing growth in the retail side, or has the repo business also bottomed out? That's my first question.
Definitely, the repo is flattish now, so it's bottom to flattish. The repo, and actually the last quarter is still going down, but we're hoping that it is flat now from this year. Actually, last year it has begun, and we're hoping that it's flat this year. But it's hard to predict. I think what's driving even the flattish nature of this business is the retail growth. That is clearly, which we're putting tremendous efforts to continue to grow. That doesn't change how we're thinking about the business. So we need to continuously grow what's and what we have control on, which is the retail business. The repo business will bounce back as and when it does. So we are hoping that it's flattened out and it's bottomed out. It's not flattened out. We're hoping it's bottomed out. But we thought that last year and it still went down. So we're just looking and saying, listen, what's in our control is doing all the other supply sources and focus on that. But we do believe it should have bottomed out, yeah.
Got it. And my last question is for Anisha, just on this. So if I just look at, the costs below EBITDA line, right, and the balance sheet and the cash flow statements, if you can just talk about, the lease cost trends, the financing costs, and the working capital intensity for the full year FY24 versus FY23, and if there's anything to, understand over there, that will be helpful.
Sure, Vijay. So I think you're in the consolidated set of accounts because it has OLX in it. It looks like a jump. But if you go independently, these are static costs, barely move because we don't have debt in the company, so we don't have any finance costs. So the only increase you see is on account of lease accounting.
Right. And why have the lease costs gone up so much? Is that all related to OLX itself, or there are lease cost increases related to the remarketing business as well?
It's just disclosed independently in each of the slides. So if you look at the standalone entities, there's the total finance cost itself is only 16 lakhs, and including depreciation, that cost is increased only by about 1.6 crores in the quarter, which includes both depreciation and finance costs. So majority of the increase is on account of the OLX acquisition, but standalone and remarketing have also marginally increased on account of additional leases that we have taken, mainly in remarketing and standalone business, one new property that we have added, or one new floor that we have added in the business.
Oh, okay, got it. Great. Yeah, I think those are my initial questions. I'll just get back into the queue. Thank you.
Sure. Thank you.
Thank you. We have our next question from the line of Siddharth Bera from Nomura. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity and congrats on a great set of numbers. Sir, first question on the OLX side again. I mean, would it be possible to share some insights into what can sort of help improve the run rate from current levels, which are the areas we plan to target in the first year, and when can we see that sort of benefit sort of coming in the revenues? It can be both on monetization or the segments which you think can help us sort of scale up faster.
Was the question on how we grow revenues? Simply, was that?
Yes, OLX, right.
Right. So OLX has got two sides of it. It's got auto and it's got non-auto. As I said, 45-50% is auto. Within auto, it's used cars basically. And obviously we believe that the used car classified business is lots of runway to grow. And OLX is obviously focused on growing used car classified revenues by adding more dealers, by increasing ARPU per dealers, providing more value to the dealers, increasing traffic and supplying more traffic to dealers. So it's a typical classified model of dealers paying subscription revenues for listing vehicles. And as I said, there are 30 million customers who come to OLX, and that is why dealers list on this platform. So clearly for us in the immediate future, I would say next 2 quarters would be focusing on the used classified business, something we understand well as a group. And that would be the big focus for, I would say, next 2 quarters. Post the 2 quarters, we are also extremely optimistic about the non-auto side. The non-auto side has got homes, jobs, electronics, two-wheelers, primarily, and household. The idea is to grow those 5 segments as well. And obviously, we're putting together a plan of action, a team, etc. In those segments, which will probably take a couple of quarters for us to understand better and then focus on growth there. But it's a two almost like a short-term growth objective and a little, I would say an immediate plan of action, which is going to use cars. And a short term would be the non-automotive segments. And of course, then in the medium and long term, going other segments as well, which are not here even there today. So the intent would be to focus on growth over the next 1 to 3 years in OLX. And there are multiple, in fact, that we believe the TAM is just unlimited. So whether it is used cars, whether it is non-automotive, in many ways, it's enhanced the TAM of the entire group, not just OLX.
Got it, sir. And just a clarification on this OLX again, I mean, when we acquired this entity, we had highlighted it had about 35 million plus MAUs. Now we are talking about 30 million. So has there been any moderation or the way accounting has changed or something like that?
I think we are also finding ways of, it's about 30 odd million now, but it's also about how analytics work, and we're given a brief indication that it was, but we also move from a global environment to our environment and the analytics related to it. So the traffic is pretty steady. I don't think, in fact, it's now we feel, there's a marginal growth we feel, but it's also how the analytics are laid out in this business.
Okay. Got it, sir. So second question on this standalone business or the consumer business, here we have seen growth rates sort of slightly coming up from, say, beginning early 20s to now mid-teens over the last 1 year. So going ahead with the industry tailwinds from like the supply normalizing, inventory levels building up, do we expect that the growth here can be faster as we go ahead into the year, because OEMs will need to spend more to sort of get customers? So any thoughts, any indications you are seeing here?
The new car business in FY23 will have about more than 40%, about 40%, I think. And this year it's about 20%, right? The new vehicle business for the consumer group. And I think the car industry last year was about 8%. So it's clearly ahead of the car industry, and it's also grown at 20% last year on a higher base of growth the previous year. We've always indicated this, that this is the rate of growth we normally see in these businesses. And the car industry is reasonably, I would say, demand has been strong and supply has been strong, which is a good place to be, I would say. Both demand and supply are reasonably strong. In fact, we had marginal growth in the car industry in April, the car companies have declared their volumes. But last year, the car industry was 8%. Whatever analysts I see and manufacturers I hear, I think they think the car industry will be between 0 and 5% growth this year. They believe that. I think that's reasonably okay for the consumer group when you have that level of growth, because it's growing on a high base too.
Okay. So lastly, in terms of Anisha, for you, basically just wanted to clarify this, that the presentation says that the cash balance is about 750 crores, but if you look at the balance sheet, the investments and cash in banks, the numbers add up to close to 670 crores. So just if you can point out where the remaining number is sort of sitting.
Sure. So there, you'll see in the caption called investments. The others will be in other balances.
Okay. And the ESOP cost of 6 crore sorry?
Sorry?
So I just was mentioning this ESOP cost of 6 crore per quarter. So this is now a sustainable run rate for the next year also, or should we expect some normalization in this number going ahead?
We can expect the ESOP cost to be around this range in the next year.
Okay. Thanks, Anisha. I'll come back.
Thank you. A reminder to all participants, you may press star and 1 to ask questions. We have our next question from the line of Ankit Kanokia from SmartSync. Please go ahead.
Thank you for taking my question and congratulations on the set of numbers. Thank you. Yeah. So my first question is related to numbers. So in the OLX business, this quarter we have seen a rise in ESOP, finance and depreciation costs. So any color on to whether this will be continued in the subsequent quarters, or we expect some moderation here?
Yeah, I think all OLX costs are almost like steady now. I think one should anticipate that some of this will, this will be a reflection of costs. Then almost.
Okay. And trade receivables have almost jumped, I think, 50% compared to last year. What is this trade receivable, if you can clarify? What are the nature of trade receivables?
Anisha can add on, but I'll just trade receivables from customers, which could be manufacturers or advertising agencies, and that's the nature of it. I think with revenue growth of 50%, trade receivable accordingly grown as well. I think that's the ratio. Anisha, you want to add on to anything?
Yes, in fact, even in the trade receivables, there will be an element of OLX which gets added because what they are looking at is the consolidated set of accounts. So there is about a 10 crore number which is from OLX, which is added to the base.
Okay. Do you expect that OLX number to come down in the subsequent quarters?
But
so the trade receivable will come. I think it will be almost steady state, right? Anisha, is that correct?
Yes, it will be a steady state number.
So this trade receivable of OLX is basically from the continuing business, not from the discontinued business.
Yes, it's from the continuing business.
Okay. My second question is related to the synergy. So what I see in Cartrade's journey is that we have acquired several businesses over several times, but I still find it unable to understand how is the synergy playing out because I see Carvale as a separate platform. I see Shriram Automall as a completely different separate. Similarly, OLX also is a wonderful platform, but how are we synergizing the benefit of all these different platforms? Because I don't see that synergy coming in. Maybe I'm unable to understand, but if you can throw some more light as to what we are working in and in how many quarters we can see that synergy benefit accruing to the company, that would be very helpful.
I think the first thing I want to clarify is that when we acquire a company, we try and look at synergy, but we also try and make sure these businesses are good on a standalone basis, which means that if there is no synergy applied to any of these businesses, they must grow revenues, margins, and customer experience in their own field independently. So these acquisitions are not done only for synergy. They were done as good independent businesses too. Of course, we believe there are customer synergies. For example, if a used car dealer today is bidding for a vehicle on Shriram Automall, that same dealer is listing a car on OLX or Carvale for sale. So that's the obvious customer synergy, right? If a consumer is coming to Carvale and sell a car or buy a new car, it's also selling a used car on OLX, right? The same customer. So there is a lot of customer synergy which exists across, which is not apparent to everybody, but exists across these platforms. Just so also when we acquired Carvale had a used car classified business and Cartrade had a used car classified business. So the first thing we did with synergy was we allowed dealers who are selling used cars to list on one technology platform cars on Carvale and Cartrade seamlessly, which means if you're a dealer and you want to sell a car, earlier you'd have to go to Carvale separately and then buy a separate package with Cartrade and then list your car. Here, on one list, you can do it with both. Obviously, when we acquired OLX, the intent would be that if you're a used car dealer using Carvale and you're using OLX, the intent would be, which is what our tech team is now currently working on, that if you want to sell your car on Carvale or OLX, with one press of one button, you can go onto both platforms, which gives dealers an access to both platforms, gives consumers to access from both inventory in both places, and obviously it helps us monetize the dealer better. So some of these synergies, whether it's customer synergies, whether it is technology synergies, we've been exploiting over the last many years. I think, and we've always tried to work at synergy at least in the group, has been on a very arm's length, win-win basis, which means we don't enforce synergies on our teams. If they believe there's a win-win relationship with another sister concern, then they choose to work with them, and it's always completely on arm's length basis, and that's the way we function. But there are a lot of customer and obvious technology synergies out there.
Great, thank you so much.
I'll give you some examples. I won't give you 2-3 examples of it, but yeah.
Yeah, and I think you only missed the Shriram Automall.
Shriram Automall. So Shriram Automall, there are 2-3 obvious synergies. Dealers buying vehicles on Shriram Automall, list on Carvale for sale. So that same dealer is being tapped by the group in 2 different places. So that's the first, customer synergy which exists automatically. But I think the one we're trying to make work, to be honest, which is harder, is people coming to Carvale or now OLX to list their car for sale, consumers like you and me. Can we get them to auction the vehicle on Shriram Automall? And that's been a harder challenge than we think. But that would be the other obvious synergy, which is still not fully exploited, I would say.
Yeah, if you can share some data related to like what you said just now, as in where a dealer who has auctioned the car can also sell the car on Carvale. So if you can share some data related to how many cross-selling opportunities or those things are there, I think that would be very helpful to us.
I think for me, from a competitor angle, we won't want the company to share the data. But I'll tell you one thing, that in fact, I said something else. I said dealers who are buying vehicles in Shriram Automall are also selling on Cartrade OLX. I think the other way around.
Yeah.
But obviously, due to competitive dynamics of the business, I'm not sure whether we will want to give out a number of dealers using all our platforms, etc., etc.
Right. One last question related to the standalone numbers. So, over the year, it is showing 20% growth, but towards the last quarter, it is showing only 15% growth. What would be the reason for this slower growth?
No reason as such. I just think that even the last base of last year is probably higher, but no reason as such. The Q4 was probably the best quarter in the consumer group ever anyway, so close to the best quarter ever. So I don't think there's anything at all. Nothing from a business standpoint we've seen.
So I know that you don't provide any guidance, but generally 20 to 25% growth rate is achievable in the foreseeable future also in the standalone business?
Yeah, as I said earlier, we tend to grow those rates in decent years. Our track record is that. So I don't want to talk about the future, but our track record is what one should see.
Thank you so much.
It may be a little different in an M&A year, because last year was an M&A year. This year, there's part effect of M&A because OLX was not fully factored last year. So it may be a little better in M&A years, but otherwise it tends to be in that range. The track record is that.
Thank you so much, and all the best for the future.
Thank you so much. Thank you.
Thank you so much. We have our next question from the line of Atul Bose from GMSS Financials. Please go ahead.
Hi, Tim. Can you hear me?
Hello. Yes, we can hear you.
Yeah. So first of all, congratulations on good set of numbers. So my question is around OLX business, that there has been a dip in margin for OLX in this quarter. So where do you see this margin stabilizing in future?
There's been a slight dip just because some costs, as we had indicated in the last earnings call, have moved from discontinuing to continuing operations. But this is normal now. So this is a normalized. Now we see the margins will improve from here. And margins will improve on account of revenue growth now. I think all the costs are factored. This is probably a completely normal quarter for OLX, and it's stable. So from here, as revenue grows, we believe that margin will continue to grow. And I've said earlier in the call that when revenue grows, we expect margins to outpace. And like you've seen the consumer group, from 19 to 26. We just also would like to see, and we believe that OLX with revenue growth will see disproportionate margin growth as well.
All right. And if you can share any color on how will the OLX revenue will shape up from long-term view?
So we had given some discussion in the call earlier, but there are two segments, automotive, non-automotive. Obviously, our intent in the immediate term right now is to grow the automotive side, which is 45-50% of the business. And over the medium, I would say short term, this is after 6 to 12 months, would be to grow the non-automotive side. But we all believe that OLX has very, very strong growth potential. The acquisition itself was probably game-changing for Cartrade as a group, and obviously given us an opportunity to explore other segments outside automotive. Although we have continued to be very bullish about used cars with OLX, it also gives us a chance to do homes and jobs and electronics, two-wheelers, etc., etc.
All right. Thank you.
Thank you.
Thank you.
Thank you.
We have our next question from the line of Arpit Shah from Stallion Assets. Please go ahead.
Hello.
Yeah, go ahead, Arpit.
Yeah, just wanted to understand the ESOP cost for FY25. Would it be around 25 crores?
Yes, I think maybe around that. That's probably right. It's probably the same rate at this quarter, so probably sure. Am I right? That's correct.
Hello.
Yeah, do you have any other question?
Yeah. So in Q3 call, I think so we had highlighted there are going to be some one-off costs in Q4 and Q1 pertaining to OLX. So can you quantify what is that number?
No, we have not indicated that. And there is no one. Everything is done. There's no one-off costs now. We had indicated that in Q3 there were some one-off costs. There's no one-off costs in Q4 or Q1 next year.
No, like we were going to see some depressed profitability in OLX business due to some reorganization which we had to complete in the auto classifieds business. So I was just asking that.
No, there is nothing. Manisha, am I correct? There's nothing now which, as you see the quarter of Q4, I think that's more of a stable state. There is no further one-off kind of cost.
What we had indicated in the Q3 results was that in Q4 we would see a bit of a decline in the profit on account of the CTX overhead being absorbed by CLA, which was already factored in the Q4 results. And Q1, the only impact until that we had indicated previously were increments, because one of our largest costs is the employee cost. So those are the only two.
But I would just would say that Q4 is now all factored in at this point.
Yes.
Got it. Now I just wanted to understand the growth for all the three businesses. If I see the consumer business, that I think so we should be growing at around 2x of the auto industry, 2 to 3x. Remarketing business will depend on the repo business, which has been degrown for FY24. How should we look at the growth part in OLX business, the auto classifieds and the non-auto classifieds? Because there we have a big potential in terms of property, electronics, and everything which is there. This is on the non-auto side. So how should we look at it? Should it be a similar consumer business kind of a growth of 20%, or should we look at it like a 30-40% kind of a number going ahead in next couple of quarters?
First, the consumer group this year at least has to go higher than the car industry does, because the car industry is supposed to get 0 to 5. So we're hoping that the consumer group growth is much stronger than double the new car industry growth for sure. That's one. But it is a factor of growth in the car industry, factor of growth in digital advertising, factor of growth of digitalization of dealerships and manufacturers and all of that. But we feel pretty optimistic about the position of the car industry or the new vehicle industry. Shriram Automall, you're right. I think the two things, one is to keep growing the retail business, and the fall in repossession is probably, we're hoping, bottomed out. But yeah, it is to keep growing the retail business, and repossessions during the year will probably come back and volumes will increase there. That will give us the growth impetus we need there. On OLX, actually, we are very bullish on growth, and I don't want to put a percentage to it, but OLX is not governed by car manufacturers or car dealers or new car sales. It's governed by a very fragmented used car market. 45-50% of this revenue comes from the used car industry, and the used car industry sells 5 to 6 million cars a year. It's been robust and buoyant for the last 3-4 years. There are thousands and thousands of dealers who use OLX for selling these cars. OLX has reasonable relevance to these dealers. A large percentage of the dealer sales comes from OLX. It is the number one used classified platform in the country. And we believe that OLX has a tremendous opportunity to grow this business. And this growth, is something we're extremely optimistic about. And one of the reasons we acquired OLX is for this growth. The second area of jobs, homes, especially, OLX is the second two categories in OLX, biggest categories in terms of revenue. Both these categories, OLX is reasonably strong in B and C towns in India for both jobs and homes. And especially in homes, it's mostly for low ticket size homes. So it's got its own segment there. And as I said, not in the immediate term, but probably in the short term, it's a 6 months. It's going to take us 6 months to put teams behind this. We see tremendous growth opportunities in both jobs and homes as well. There are two other categories, which is bikes and electronics, which is OLX extreme. In fact, today, if any one of us wants to sell a two-wheeler or a mobile phone, OLX is probably the platform we would use. And they're again very, very strong at that. It is a category we believe also we can monetize extremely well in the next 2 to 3 to 4 to 5 years. So we have lots of plans around all these categories. And therefore, I don't want to put a percentage of growth, but we feel very optimistic about the growth at OLX.
Got it. I just wanted to understand, now we have complete dominance on the used car market. From the Cartrade acquisition 2016, the way we started 2012, started Cartrade, and now we have OLX Auto also. So how should we look at the J curve in terms of profitability? Because by today, if I see a profitability, we are probably on a run rate of 100 crore PAT maybe in FY25. How should we look at the J curve? Because we have worked really hard for the last 6-9 years to make this kind of a dominance. So when should we expect to see a very big jump in profitability for a company? Because now we're a really dominant player in the field that we're operating. How should we look at that?
Yeah, so first, we have good relevance with, especially used cars. We have strong relevance with used car dealers and used car consumers. I agree with you. I mean, with this 24-25 crore PAT, that's probably the current run rate of profitability. We do believe that revenues, with growth of revenue, the profitability should rise and margins should rise. That's the nature of the business. The cost don't go in relation to revenues. So we feel very optimistic about profitability for the next 1, 2, 3, 4 years. Clearly, And we also believe that one of the biggest opportunities within the company are used car classifieds. We do believe that. With the acquisition of OLX, our ability to focus on used car classifieds with consumers and dealers becomes even stronger, being OLX being the largest player at this. So clearly, used car classifieds is important. Clearly, it will help drive revenue growth and profitability growth for the group. Used car classifieds, the business is already profitable for us. In fact, all our business are individually profitable. So we feel quite optimistic about profitability growth as well as revenue growth.
Got it. Thank you so much. Best of luck.
Thank you so much. Thank you.
Thank you, sir. A reminder to all participants, you may press star and 1 to ask questions. We have our next question from the line of Mr. Sahil Doshi from Thinkwise. Please go ahead.
Hi, sir. Good afternoon. My question relates
Sorry to interrupt, Mr. Sahil. Can you please use the handset?
Am I audible now?
Yes.
Yes. So the question relates to OLX. In terms of, could you just help us understand, what is the kind of paid listings we have and what is the growth which we are seeing there organically and how much of it is driven by ARPU possibly? I understand it's a little too early, but if you can just help us get a direction of that will really help us understand the size of opportunity.
Sorry, can you just, the ARPU of, sorry, I didn't get the last part.
If you could possibly bifurcate how much of it you are expecting from the ARPU driving. Yes.
It's hard to give percentage, but we expect a growth in number of dealers, the number of people paying, as well as ARPUs both.
Okay. So could you possibly quantify the number of paid listings we would have today in OLX?
As of now, we are not, sharing that. In future we will try and share some of the metrics. But it is probably the largest marketplace in India with consumer paid listings. We have two sets of paid listings. One is consumer listings for paid and dealer listings for paid. We are still not sharing the total number of paid versus total number of listings. Going forward, we'll try and share some of this data. But the objective is to grow all paid listers, and the objective is also to grow ARPU for paid listers. So,
understood. Appreciate that. So, is there any sense on the average ARPU? Meaning, what will be an average ARPU for a paid listing or a paid?
We'll have to give it distinctly because it's by segment, right? So it could be a consumer listing a phone or a consumer listing a car that is different. And that's live on the website, actually, the cost for it. Or it could be a dealer, again, listing a car or a two-wheeler or a home. So it's hard to put an ARPU to this. There's just different rates for different listers.
Okay, understood. Appreciate it. And the second question is on the standalone business, where we've seen a little bit of a dip compared to our past run rate of growth at around 15% YOY this quarter.
Yes.
Any reason why this is happening? Is it because this is contrary to the fact that the number of users and the conversion, the organic traffic has actually gone up? So
that is correct. The organic traffic has gone up. It's higher because the standalone business probably had the best operating revenue growth, best revenue, operating revenue ever in its history. So it is on a high last year base as well. The last year, I said, grew again at a very high pace, and this has grown 20% Y on Y over above that base. But also you got to remember that the growth in the car industry, from more than double-digit growth the previous year, come down to 8% this in FY24, and only 2% in April, right? So there is also a bit of car industry growth factor here. But as I said, we feel pretty good about the industry state and the consumer group state, and I think these are now normal growth rates about what we're showing in the track record we had in the last 2 years.
Understood. Final question from my end is, sir, when do we see the initiative which we are working on, the one click and a lot of other initiatives around financing or the Cartrade or basically the website which you're trying? When do you see that actually becoming meaningful in terms of monetization for the platform?
So the one-click journey of giving an ability to someone buy a loan or a vehicle is going on. There are already some elements of that live. For example, on financing is definitely live on Carwale, Bikewale, and multiple other platforms where you can get a loan immediately approved. We also work with various car manufacturers with their dealerships and their website to allow these finance products to work. And that's a continuous exercise for us. It's already become significant in terms of customer experience. I mean, tens of thousands of people get approvals every month on this technology of a financing or a fintech product. And the fintech product of the buy one click has got two parts of it. I think the first part we've always said is about customer experience, allowing consumers to have a superior financing or buying experience, which is what we primarily work on. The second part of it is, can we monetize it better? And then the monetization becomes significant. I think the monetization is something which is secondary to us right now around it. We've always said that this whole financing or buy one click is about customer experience and giving the ability for a consumer to have a quick, convenient experience to do something on Carvale, Bytale, and even OLX in the next few quarters. The financing product will get launched there as well. So the intent is, of course, to take this buy one click journey across all our platforms, including OLX. And the intent is also to get better customer experience. Monetization, this customer is already monetized by way of charging dealers and et cetera, et cetera. We're not so worried about it. Our margins are also improving as increased revenue. So we're not worried about that. I think the biggest thing for us is how do we enhance the use of this product, and then how do we make the experience of the journey of buying a vehicle or a used car or a two-wheeler more easy by this one-click financing or one-click buying approach.
Sure, sir. That is very helpful. Thank you, sir.
Yeah, thank you. Thank you.
Thank you, sir. We have our next question from the line of Aniket Kulkarni from BMSPL Capital. Please go ahead.
Yeah, good afternoon. Thank you for the opportunity. So you have given your presentation that you are close to 750 crores in cash balance in there. So how do you plan to utilize this cash, and if you can give any outlay for the same for the current year or the next year?
Yeah, the cash which is there, obviously the intent is to look at future growth in the business. OLX is a very game-changing acquisition for the group, and obviously over the next 2 to 3 years, as and when we find another opportunity, we will look at it. And if we don't, we won't. And obviously, the intent will be over a period of time to distribute it back to shareholders and stakeholders as we go on. So the two uses, I said, one is probably in the near term or medium term, if we do find another M&A opportunity. As you know, it takes a long time for us to find something. After Shriram Automall in 2018, OLX was in 2023, so that's 5 years later. So until we find something and we feel really good that we can turn it around and exploit all the synergies, obviously we won't make an acquisition. And if we do not, as you know, we are profitable, generating cash, and the 750 crores will keep growing. And we will obviously look at returning it when it's possible to do to shareholders and stakeholders, obviously.
All right, thank you so much.
Thank you.
Thank you, sir. We have our next question from the line of Rahul Rahane from Goldman Sachs. Please go ahead.
Hello.
Hello. Hi, Rahul.
Hey, Vinay. Hi. Just wanted to get an update in terms of, the AppSure foray that we had in terms of certified vehicles, how is that going? Because I think a couple of quarters we've kind of not mentioned the number of outlets, etc. So just wanted to understand how that's going, what's the throughput over there, just some bit on that.
Actually, it's a good question. The OLX acquisition actually changed this a little bit, where OLX also had an equal number of, or similar number of certified stores, OLX stores. So by force, obviously number of stores we have doubled, which I think is close to 220 or 230 today, automatically. We are working on a very deep strategy on how to look at these stores in relation to where we want to grow it, number one, of course, but also do we want to combine the OLX Carvale store or not, or at least not combine the stores, at least provide similar technology and features and products to both stores, right? So, that's a big game-changing thing. But independently, the Carvale, AppSure, and Signature stores have grown, and independently we have acquired OLX. So it's actually doubled our coverage automatically, and it's a very big focus area for the next 12 months to first come out of the product, which is uniform for both OLX and Carvale stores, and the second is to, of course, then keep growing these stores, both of these.
Got it. So currently they are running independently, but you would look to, let's say there is someone who sold his vehicle on an OLX, the same car probably sometime down the line will also be available to sell on Carvale AppSure.
We are still working through the modalities of how do the franchise store of OLX and Carvale get the same, products and services. So it'll take us some business where the synergies, come in. It'll take us some time. But the fact that we're 220 coverage points makes us very excited about this area. It's actually doubled our coverage automatically, actually.
Understood. And on a standalone basis, in terms of AbSure, would they have kind of stabilized now in terms of, profitability on a per store basis? What's the throughput number of cars required per month? Any kind of metrics around?
It is quite stable, but it's also always, because it's an asset-light business for us. So again, it's a reasonably high margin business. It doesn't, there's very little cost against it except variable manpower. Then, as I said, no marketing cost against it or no capex against it. So it's just variable manpower for which work on the processing system to store. So we feel it's a very attractive business for us. And that's why we feel excited about the OLX acquisition. Not only help the use classified business, but definitely help the signature/AbSure business as well.
Got it. And just on the consumer piece, if you could, kind of say for the full year FY24 versus 23, a broad split between, our revenues, how much would have come from auto manufacturers versus dealers?
Yeah, pretty stable. Actually, we didn't, this is not my mistake, we didn't do this in the original presentation. But it's pretty similar. 85-15 is new and used, OEM dealers about, 65-35 in Q4. It's quite stable. In fact, some of the other metrics were, repo for the year is about 49%, which is, down. The 49% is slightly lower. So I think the percentages are quite stable to what they were the previous quarter, so we have not given it out. But yeah, your question was on OEM versus dealer 65-35.
65-35. And this number, let's say, going forward, in a scenario where now there is no, kind of pent-up demand on the customer side, one would assume that OEMs will need to spend more in terms of advertising, right, to kind of attract demand. So this proportion would ideally move in favor of OEMs. That would be the right way to think about it?
No, we think the other way around. Logically, we should move in side of dealers, but it's been quite stable over the last 4 or 5 quarters. So it's hard to say, but we actually believe that, it should be quite favoring dealers as dealers advertise more. It is more from that angle. But as of now, it's been quite stable, actually, to be honest.
Okay. Sure. Thanks, Vinay.
Thank you.
Thank you, sir. We have our next question from the line of Nitin Shakdher from Green Capital Single Family Office. Please go ahead.
Hi, good afternoon, Vinay. Good afternoon, Anisha. First of all, congratulations on the steady bounce back and the promise that there will be no further write-offs on the business. So can you take that as gospel that there shouldn't be any further one-off write-offs because that spoils the annual trend?
Actually, the only write-off we had was on discontinuing a business which we had said we had discontinued. Otherwise, we might have one anyway. So I don't want to talk about the future, but clearly in the last couple of years, the only thing has really been that one discontinuing business, which is a company which we acquired and kept it classified and discontinued C2B. But there's no anticipated write-off of that in the question.
Okay, great. And my second thing is you spoke about briefly, but I just want to get a bit specific. Obviously, the cash and bank balance is far healthier right now to what it was last year, and the closing position seems fairly good. Now, while you're doing acquiring and M&A and strategies which take time and synergies built up over time, I just want you to consider specifically a solution for existing institutional as well as shareholders in terms of can you evaluate a buyback if that's accretive towards your ratios and things like that, or a dividend strategy because, it has to be something given to shareholders as well, considering you came in at 1,500 on an IPO and it's already 2.5, 3 years. There has to be something. You're constantly expanding the ESOP pool, but I don't see you returning a lot more back to the shareholders at a significant push there. Any thoughts on that?
Sure. I think 2 things. One is that in the IPO, we did only secondary, no primary raise into the company, number 1. The second part is actually the ESOP cost for the last 3 years will continuously come down. So that is the second part, on 27 crores down to 22 crores this year. The second part is that. The third was we would absolutely look at buybacks and dividends as and when we think that the money can be distributed back. There is regulation today dictating what quantum of buybacks and dividend distribution we can do. So we obviously have to work within the guidelines of the regulation, and we're restricted from doing certain things by regulation itself. And as and when the regulation allows us to distribute in terms of buyback or dividend, we'll absolutely would like to do so.
Yeah, I mean, it's just a request. At the end of the day, the company knows better in terms of financial management and engineering. But I think you should consider that also significantly for this year, considering the start of the year, and put that as how you could sort of work on that. That's just a request.
Yeah, we will, but we can only within the constraints of the regulation. That's all I'm saying. So, and the Companies Act.
Okay, thanks a lot.
Thank you.
Yeah.
Thank you, sir. We have our next question from the line of Rishikesh Oza from Robo Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. Sir, for FY24, our net revenues have grown by 32%, while our adjusted EBITDA has grown 63%. So can you indicate how are we looking our revenue growth at for, let's say, for next 2 to 3 years? And would it be fair to say that our EBITDA growth would be 2x of revenue growth going ahead also?
Yeah, we see a strong position on terms of revenue growth, etc. And you also indicated earlier that our profitability tends to grow at a much sharper pace than our revenue growth. It tends to be 1.5 to 2 times. I would say more 1.5. If revenue goes 100 rupees and profitability tends to go by 150. I think that is if 100% then 150%. So or 1% and 1.5%. I think I would take that ratio. That's what tends to be. Sometimes it's better than that. Just now it is currently better than that. But it tends to be that's the way it grows. Because our costs would go up along with our revenue growth, only our people costs.
Okay. Thank you.
Thank you.
Thank you, sir. We have our next question from the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you, and congratulations for a good set of numbers.
Thank you.
Yeah, I wanted to ask on this Carwale, your revenue has grown, but your expenses have grown higher. And this is a fairly mature business. So, how does the operating leverage play out in this business?
So, if you see, the revenue growth is for the year is about 20% from operations, standalone, which is our consumer group. And our expenses have grown by, I think, 16%. Are you sure that's correct? 16%. So actually, the expenses have not grown the same way the revenue. That's why we have 41% growth in adjusted EBITDA.
Okay.
So actually, the way to look at it is revenue growth is 20%. Adjusted
so once
EBITDA
you look at the annual, not the quarterly numbers, is that what?
Yeah, I'm looking at the annual numbers.
Because annual revenue has grown 19% and even employee cost has grown 19%. So,
employee cost has, but as I said, the marketing cost only up 7%. Other expenses are 15%. So aggregate.
But this is a business based on internet advertising, right? So why would employee costs go up?
It is not necessarily. It's a mix of course, internet advertising for manufacturers and dealers, but it's also about adding more. All our technology development in the future goes to revenue expense. So if we develop future technologies in a tech product team, any expansion goes to employee cost. Any expansion of field force or call centers goes also to employee cost. And that's the number one cost which tends to go up. As I said, in a lot of companies, employee costs, marketing costs, operating costs all go up. In our case, variable manpower is what goes up, and we, as the company keeps growing. And therefore, you see even then a 20% revenue from operation growth has got a 41% growth in adjusted EBITDA.
Okay. And on the OLX acquisition, what is going to be your policy to write off the cost of acquisition? Are you going to expenses to P&L or would it carry on in the balance sheet?
The OLX acquisition is being captured as in our goodwill. The acquisition value itself is captured in our goodwill, which is reflecting on our balance sheet. And actually, the objective is to give a return on that capital employed and not write it off, because we obviously believe that the acquisition itself is value creating. So.
Okay, so no plans to amortize it?
No, there's no amortization of goodwill.
Okay, thank you.
Thank you.
Thank you, sir. We have our next question from the line of Vijay Jain from Citi. Please go ahead.
Yeah, hi. Thank you for the opportunity again. 2 follow-up questions. One, Vinay, in general, for the standalone business, for the industry overall, just your comments on, do you see dealers being subdued generally in F24 relative to other segments of the business across new and used businesses? In general, whatever you can talk about, what you see on the dealer side for the industry. That's my first question.
Do you see dealers mean in terms of supply, or do you see them in terms of health of dealers?
Just in terms of their willingness to spend on platform or on your kinds of platforms, etc., for marketing and for acquiring vehicles in the used side, both those things.
Yeah, we've generally seen we've been through a trend in the new car industry trend. So we basically what we've seen till 2-3 years ago. Maybe 2 years ago, the dealers and manufacturers cutting or reluctant to spend because certain vehicles are not available for supply. There were supply chain issues, etc. There were posts coming out of COVID. Then the volumes of sales have gone up, and now demand seems good and supply seems good. So we're in a favorable situation where supply is available and demand is good as well. So dealers tend to spend, and manufacturers tend to spend too to increase sales because there is supply available. I think in the used car industry, it's very early days in monetization by itself. Even though OLX is very strong at it, it's very, very early days. The used car dealers are still not got used to spending large amounts of money on advertising or selling of vehicles. And I think that change is now ready to happen where if dealers have to, divert lots of their money towards digital advertising or spending money on selling the vehicles on platforms like OLX. So that trend is still, I would say, probably going to start in India now.
Correct. Thanks, Vinay. And my last question on the standalone business side. I know you don't have a guidance as such on the growth side, but I'm just wondering if there's a certain growth rate you need for margins to expand in F25 versus what you had in F24. Is 15-16% growth rate in the standalone business good enough for margins to expand? Given I asked that because obviously
whether you have 10% or you have 15%, you have 20% or 30%, margin expansion will probably happen in all our businesses. I think internally also, and we said in the last call, and you've seen this in the consumer group of 19 to 26%. We have given tremendous guidance to all our teams to improve margins. I think we are a management or a company which is not only focused on revenue growth and customer growth and customer satisfaction and delight and building great product and tech, but we also believe in working around and making sure our margins continuously improve. And even over the last 3-4 years, the company has continuously demonstrated how the margins have gone up as increased in revenue. So we believe that this year, in addition, we should see, irrespective of revenue growth, we should see margin growth.
Got it. Thanks. That's very helpful, Vinay. Thank you.
Yeah.
Those are my questions.
Thank you. That would be the last question for today. I would now like to hand the conference over to management for closing comments.
I just want to thank all of you for joining in for this 1-hour session, and we feel, pretty optimistic about the position of the company as demonstrated as well in the foundation, the base we have from our last financial results in Q4 of last year. Look forward to seeing you again in the next quarter results, but thank you for joining in today. All the best. Thank you.
Thank you. On behalf of Cartrade Tech Limited, we conclude this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.